Hey, it's Matt here. I thank you so much for continuing on to part 2 of this video series on loan modifications. You know, applying for a loan modification can be a complex process, and homeowners often wonder, you know, what is the bank specifically looking for during this review time? Well, there really isn't a one-size-fits-all, because there's variations in lenders and investors, but there are some general factors that banks consider when reviewing a loan modification application, which I'd like to go over with you here. And the first thing I want to mention is there has to be a valid hardship. You know, the first thing a bank looks for is a valid hardship, which really essentially explains why you fell behind on your payments, on your mortgage payments. So banks, they want assurance that your default was really due to a legitimate financial challenge and not due to maybe irresponsible spending. Valid hardships include things like a job loss, illness, or other circumstances that can impact your income. Another thing they're looking for is they want to verify stable income. It's a critical factor in the loan modification review. Banks, of course, they want to minimize the risk of you defaulting again, so they closely examine your income's stability and longevity. So they're going to assess like whether your income is steady is it weekly or bi-weekly or once a month, or is it temporary and sort of sporadic. To show stable income is essential. It's essential to document it clearly for the bank, as they want to ensure that you can consistently make payments under the modified loan terms. Another one is banks always also evaluate the affordability of the modified mortgage payment. There is a common misconception that a loan modification will drastically reduce your monthly payments, but typically the new payment is close, if not sometimes more, than the original payment. Banks use two key metrics to gauge affordability. The first one is called the front-end debt-to-income ratio. And this ratio compares your monthly mortgage payment to your total monthly income. Generally, banks are looking for this ratio to be in that 30 to 35%. That will ensure that you have funds left over for other essential expenses. That calculation is pretty simple. It's just your total mortgage payment divided by your total monthly income. Should come up with a number like 0.3 to 0.35. The second calculation is what they call the back-end debt-to-income ratio. Very similar to the first. It includes the household expenses with the mortgage payment. So banks prefer this ratio to be reasonably between 45 to 65% to allow for emergency funds. A high ratio may indicate that you're financially stretched, which could raise concerns about your ability to make consistent payments. You know, the calculation for this back-end debt-to-income ratio is simple. It's all of your monthly expenses, your standard expenses plus your mortgage payment divided by your monthly income. Now, in the process of reviewing and evaluating your loan application, your loan modification application, banks sometimes would consider putting a plan together that's called a repayment plan. They might think that's more suitable for you than the full loan modification. And all a repayment plan is you make your regular mortgage payment plus an additional amount each month to catch up on the missed payments. Now, the reason a bank might suggest this is because you're showing that you do have enough excess income at the end of each month to make an extra payment. So now here's the caution. When you're completing your loan modification application, you might have a tendency to minimize your expenses to make you appear as though you have excess cash and they don't have any concern that you can make your payments. But if you do that and it's not fully accurate, then that could cause them to give you a repayment plan. And if the repayment plan is based upon inaccurate reporting of expenses, that could really make it financially demanding to keep up with those. Another thing that banks look at is your past loan modification history. Some investors limit the number of modifications, allowing one over the lifetime of your loan. For example, certain lenders may only permit 2 modifications, regardless of how much time in between, while others might impose a waiting period, such as maybe there's only 1 every 24 months. So if you do have a history of loan modifications, you have to realize the bank is going to consider that factor when they do the review. So after reviewing these standards that I've just gone over with you, you feel confident that you meet the requirements that I've laid out for you, then I would encourage you to be working on getting that loan modification application in as soon as possible. But I would also say this: I would encourage you to not put all of your eggs in that basket. I would encourage you to also then work on a backup plan. What do you do if you get a denial and you can't get it corrected? Because unfortunately, the loan modification approval process is time consuming, and it usually eats up most all of the time that you have in your timeline for a foreclosure. So it's good to have a backup plan. Now, what do you need for a loan modification application? Typically, it's 2 years of your W-2s, tax returns. If you're your own business, if you have a business, you need a profit and loss statement. You're going to need the last 60 days of pay stubs and bank statements, and you're going to need that hardship letter. And I'd be happy to help you with that hardship letter if you'd like. And also, you need to be prepared, like things like bank statements and pay stubs. You need to be prepared every 30 days to update those because they have to be renewed. Now, here's some steps that I think can help you achieve an approval of your loan modification. And the first is contact the lender early. You know, if you've experienced some financial hardship and are struggling to make your payments, even if you're just anticipating missing payments, reach out to your mortgage lender. Start communicating. You know, communication shows your intention to get caught up on your home loan. So you want, and when you do communicate, tell them, hey, I want to stay in my house, and express your willingness to work towards a solution. Now, remember, if you want to stay in the house, it's important that you clearly communicate that. They need to hear that, that's your desire, and so and that you're committed to doing whatever it takes to make that happen. And then you want to be proactively engaging with your mortgage lender. That also builds trust and increases the likelihood of approval throughout the loan modification process. And now, so after initial contact, you need to complete the loan modification application right away as part of that process. This typically is going to involve explaining your situation. That's the hardship letter. You need to provide evidence that the property in question is your primary residence, and you need to detail your current financial capacity to make the mortgage payments. You'll need to provide those documents to verify your monthly income, such as pay stubs and profit and loss statements and bank statements. You need to be concise. This is important. Be concise and factual in your explanations. There's no need to get into lengthy emotional narratives. Submit exactly what they ask for and no more and no less. Avoid oversharing, as any additional information that really might they could be used against you for a denial. And if you don't have a requested document, note it right up front. Make it very clear that you don't have it and why you don't have it. Another thing is ignoring their call or their letters. It can severely damage your chances of approval. Instead, maintain and be consistent in your communications. Even if your financial situation hasn't changed, keep your lender updated and informed. It really shows responsibility, and communicate that you want to resolve the issue. And then once again, a very, very important part is crafting that financial hardship letter, and it's one of the most critical elements. So now that letter explains the circumstances that led to your financial hardship, and it's really crucial to gaining the lender's empathy and approval. So here are some tips for writing an effective hardship letter. First of all, focus on external factors. Mention circumstances beyond your control, such as the layoffs, the illness, the economic downturn. And you want to avoid discussing personal financial mistakes. As lenders, they might look at that as, maybe some ongoing mismanagement is going to happen here. And then you want to keep it professional. While it's essential to explain your situation, avoid emotional language or assigning blame. Instead, stick to the facts and describe how you plan to recover financially. And then additionally, show responsibility by moving forward by telling them what your plan is for financial stability and reinforcing your commitment to meeting your obligations in the future. So the whole process of the loan modification review process has two parts. The first part is the document collection stage and review stage. And after you submit your package, you want it to move forward smoothly. So let's talk about that, how to do that document review phase, the initial phase, correctly. It's very critical for ensuring that your file gets deemed complete and is ready for the next step. Now, in the document review phase, the first person that you're going to be dealing with is the document processor. Sometimes they're called the customer relationship manager or the single point of contact, or maybe an asset manager. Every lender has a different name for them, but they're assigned to your documents. And it's important to realize these people are dealing with hundreds of these on their desks. It's not just yours. And at this stage, they're going to be examining your financial data. They're not going to be examining financial data. They're rather just collecting the documents and organizing it properly. And so the goal that you want to accomplish is you want them to deem or say that your package is complete. Because when your package is complete, that means they can move it on to phase 2. And when that happens, you have the chance of calling and getting your sale date delayed even further. Now, many borrowers experience delays, and it's due to things like missing or incomplete documents, which can lead to a really frustrating feeling of like it's never ending. You're constantly collecting and resending in documents. So once you have sent in all your documents to the lender, and you start following up, here is what you're going to hear. Preparing you for frustration, right? It's still in document imaging. Check back in a week. Some of the pages were cut off. It wasn't legible. Remember, you cannot just send it in and wait. Counting on them to handle it with the level of urgency that you want it to be handled or it needs to be handled because you have an auction date just doesn't happen, because they've got hundreds of these on their desk. So you must keep the ball rolling by following up. See, a document processor really handles three things. They upload the documents. When they arrive, they sort them, they upload them and they sort them, they make sure they get into all the right file folders. Okay, then they do verify the documents. They look at the documents and see, is it what you say it is? Is there anything clearly missing? And so they do a cursory, an initial check on the documents. And then thirdly, if there's missing documents, they make a list of it, and they will communicate that to you through an email or a note in your profile, or maybe snail mail, or maybe a phone call. There's some common issues in the review stage, and several common issues that can slow the process down is requests for non-existent documents. See, if the processor requested documents and they don't exist, such as pay stubs or self-employment individuals, financial statements or bank statements, you need to submit a letter when you submit the application explaining why they're not there. This helps the processor understand your situation and at least to mark that category as they addressed it already. And then also incorrect document uploads. Sometimes processors make misplaced documents. They make a mistake in the way where they uploaded it to, or it gets lost. If this happens, the best approach, just resend the document, even though you know you sent it before. Now, I want to give you 6 tips. These are really, really good tips that will help to move the document review phase forward more successfully. So the first of those tips is you got to call regularly. You cannot count on them. If you sit back and wait for them to call you for something missing, it's going to take forever and a day. So call regularly. I would recommend every 72 hours, put a call in to your lender, and I want you to ask these questions. Ask if the file is listed as complete yet. Because remember, if it's complete, then you can pursue getting your sale date delayed. Ask them if there's any documents missing and what are they. And ask them what was the last time the file was reviewed. See, regular communication is going to help you quickly address any issues rather than waiting on them to contact you. And also, I want you to keep a journal of every time that you have spoken with the lender. Date, time, the name of the person you spoke with, and the kind of information you found out. And then you want to keep there are certain documents you've just got to keep updated. Your pay stubs, your bank statements need to be updated every 30 days. So instead of waiting for them to ask for an update, every 30 days, whenever you get a new pay stub, send it in. Whenever you get a new bank statement, send it in. And then you want to make sure that when you're completing your loan application documents that you're doing it correctly. And so there's oftentimes videos or descriptions, written descriptions on how to fill out a form. And so read over those, do it correctly. And another tip is do not leave any blank lines empty. Always, if it doesn't apply or you don't have it, put NA. Leave nothing blank. Another tip is this: they don't like working with Word documents that are in a format that could be edited. They want them in a PDF file, so you want to send them in a PDF file. And here's an important one: only submit documents that are asked for. Avoid overwhelming the processor with unnecessary documents. Confirm with the lender what's needed, and only submit those items. This minimizes confusion and helps speed up the review process. And we've gone over this before, but if you're lacking certain documents, include a letter of explanation why. For example, if you didn't receive a pay stub, send a letter telling why. Just say, I did not receive a pay stub that month. This really helps the processor not have to go back and forth with you for an answer why they know right then. They can just simply mark it as it's been addressed. So now we're on to underwriting phase 2. See, once your document is deemed complete, it goes to the underwriter for him to make the financial evaluation and see what he can come up with in a loan modification proposal. During this phase, the underwriter reviews all that financial data to make his determination. The better that you do phase 1, the more efficiently that you do phase 1, it really, really sets the foundation for a smooth review process. By staying organized, regularly updating your lender, and carefully following the document guidelines, you increase your chances of moving forward and getting an approval. Now, what happens if it comes back as denied? Well, it does. In some cases, it does come back denied. But the first thing I want you to do is don't get discouraged. I want you instead to stay persistent, because persistence can often lead to even a favorable result after a denial. So if you're denied, politely ask them for what reason, and then I want you to address any missing documents, and then if it seems reasonable, I'd consider resubmitting your application. Sometimes even rephrasing your hardship letter can make a significant difference. So my final thoughts, getting a loan modification approved is possible with clear communications, timely responses, and a well-crafted hardship letter. By following these steps and maintaining a proactive stance, you can increase your chances of staying in your home and regaining financial stability. Now, if you have any questions or you need guidance on a loan modification, I want you to feel free to reach out to me through my website. It's www.foreclosuresolutions.com. And I hope this information has been helpful for you. If you could give us a thumbs up and follow our page, I think you'll continue to find really valuable information there. I look forward to seeing you next time.